Gower here, founder of gowercrowd.com and host of this podcast and YouTube show, Real Estate Market Watch, current events through a real estate lens. All I can say about today's conversation is, oh my goodness me, this is incredible conversation. You have to listen to this. I am speaking with Phil Anderson of Property Sharemarket Economics, but he is famous for his book, The Secret Life of Real Estate and Banking, where he goes back a couple hundred years or more and looks at how the real estate market cycles and has identified highly predictable patterns and predicts actually based on that research that we are in the very, very final innings of the current cycle. So his thinking is almost exactly aligned with my own. So if you don't like my thinking, hang up now, basically. But if you do think there's some validity to it, you're going to find my conversation with Phil Anderson absolutely fascinating. We cover all kinds of topics from economic, current administration's economic doctrines to the dollar privilege to where we are in the cycle. And right at the end of our conversation, the one question, of course, that everybody wants to know is, okay, if I buy into this story, what do I need to be doing? Phil answers that very, very precisely with clarity, and that also actually dovetails directly into the recommendations that I've been making and some of the actions that I've been doing. So make sure you stick around for the very end of our conversation to hear how he suggests you should be thinking about investments today. If you've not already done so, please go to gowercrowd.com, subscribe to the Gower Crowd newsletter. Just hit the subscribe button and you will get analysis and updates that are currently based on the conversations that I'm having in this podcast series, including my conversation with Phil and with all my other guests. All right, so that's all at gowercrowd.com. All right, let's get on with it. Phil Anderson, Property Sharemarket Economics. Woof, this is a good one. Phil, it's always such a pleasure to see you. Thank you so much for joining me again today. It's been a while since we last spoke. Go ahead.
Hiya.
The world has changed dramatically, particularly in the United States, since we last spoke. It was totally unpredictable at that time. But first question, of course, Mr. 18.6 year real estate property cycle. Where are we, Phil, in the cycle right now?
Well, it's Adam. I think it's debatable that much has changed.
Okay.
Let me start off by suggesting that when I chat a lot, I don't do this so much anymore, but when I do chat with people, I'm just another economist and I'm just giving opinions and saying my point of view and things. But I would like the viewers just to consider one thing, and that's if I got a pencil here, right? And if I drop this pencil, we know that the pencil's going to fall to the ground, and we know that because the law of gravity, which we accept and which we know from science to be realistic, and we know not even just science, we know some from observation, nobody's going to suggest that the pencil's going to go upwards, right? It's just the natural law we accept. In economics, there is also a law that absolutely nobody comes to get anymore, and it's what I call the law of economic rent. And the law of economic rent is to economics what the law of gravity is to science. And the law of economic rent basically suggests, in a nutshell, that all of society's gains, all the benefits, will gravitate in the end to the price of land, or to the earnings of land, say. And if a society allows the earnings of land to capitalize into a price, and that those earnings as a price, usually it's 20 years of earnings gives the price of land. The banks are then permitted to raise credit based on that price, and we all have to get a mortgage to go and buy our land with the house on top. Then we will get a real estate cycle. Not just we will, we absolutely must. And then the only question you have to ask after that is why the real estate cycle has been so incredibly reliable at between 18 to 20 years. This has been known for a long time. Legendary traders like W.D. Gann and there were other people before him, economists as well, knew that economics had a cycle. Generally it's some sort of decade cycle, but 2-decade cycles into a real estate cycle. And so once we know this, that we must get a real estate cycle, then you can just start to ask, all right, it's regular at 18 to 20 years. Then we can start working out sort of where we are within each real estate cycle. Okay. And that brings us to then your question about where are we? And history suggests that we're running into the last couple of years of the cycle. So when we get to the last couple of years of the cycle, history suggests that usually in the first half of the cycle, which was running from about 2012 to about 2021, that's when the rent has to be earned again, and we need a recovery in it. In the second half of the cycle, the earnings of land, the economic rent, start to manifest itself, and it starts to be spent quite widely. And so the second half of a real estate cycle is usually, or it's always marked by a prodigious increase in speculation. We get the building and announcement of continually higher buildings. We get the world's largest, biggest, tallest. And also, since the time of Abraham Lincoln, there has only ever been a Republican president elected shall I say, there's always been a Republican at the helm into the last couple of years. And in my opinion, here we go again with an alleged Republican, Donald Trump. He's changed the face of that party a bit, had been coming to power, and in my humble opinion, you have the ultimate end to this particular real estate cycle is being played out with an ultimate real estate speculator in the White House. So that's how I think the second half is playing out, and why I think we're sort of towards the end. So what we should be seeing is a good deal of speculation, and look where Bitcoin's going. And I found it ironic from my perspective when I look at real estate cycles, and I look at it from a rent point of view and from a land point of view, and not many people do these days. Land's been written completely out of the economic equation, out of economic textbooks. Land is no longer a factor of production, but I think it is. So I found it interesting and somewhat ironic that the first place that a speculator president goes to is where the ultimate economic rent manifests, and that's oil rent in Saudi Arabia, the UAE, and Qatar. So real estate cycle is looking pretty good for me to play out at the moment in the final couple of years.
Okay, actually, okay, that's really interesting. Just go ahead and explain that a little, because my question was going to be, how does having a real estate guy in the White House? I did notice, I think you said somewhere, the only other time that's happened was George Washington.
Well, yes, well, George Washington being the first president, he was the largest landowner in America, if not the world, at the time when he took up the first presidency. So now we have number 47. So it's an interesting bookend at this stage.
But just connect the dots for me. Explain this concept of land and connect the dots to to the oil-rich countries of the Middle East, and the fact that we have a real estate developer president charging out there right at the end of the cycle. Help me understand why that's important.
Well, before the First World War, it was generally considered that there were three factors of production that basically produced wealth. Everything you see around you, the books and the background that we have and all the wealth that's in the world. You needed labor, you needed capital equipment, and you needed land upon which to create that wealth. And up until the First World War, most societies were reasonably agrarian still. So land was kind of obvious, and most people accepted that when you studied economics, you studied cyclical behaviour. Along came John Maynard Keynes, and he had some interesting proposals to suggest that the government could actually help alleviate those particular cycles, so that in tough times the government could spend money and recover from the cycle. And then the corollary of that was really with what Maynard Keynes was saying, was suggesting that in good times government should recover some of that money back, such that balancing budgets again, so that we wouldn't get this wild continual spending by government. So government's become a lot bigger than it used to be. And so it was accepted by most economists that you studied land and you studied those sort of things. And there was up until about 1907, thereabouts, First World War, there was a lot of land reform movements coming through that suggested that to end some of the cyclical behaviour, you could actually tax the land, and you could actually raise some revenue that way. And that's the antithesis of most of the people who end up highly in politics. They don't really want you to know about that. So there was a number of people employed to eradicate land from economics. And so it was generally from about after the First World War, all of that was put into economics, such that the land as such was written out of the economic textbook. So now, these days, there's only two factors of production, labour and capital, and land is considered part of capital. Now, that's all right if people want to do it that way. It's just that these days, the economists, they will never see the end of the real estate cycle coming because they don't understand the land question. And so if you have a look back in history, if you have a look back to 2007, 2008, you go back to 1991, you go back through the early 1970s, and you go back to the 1920s, the cause of moving from an economy that was running really well into a recession was the deflating of land price. And so that was reasonably well seen back in 2008, because we had the mortgage system in the United States got clogged up, and it was all a backing of mortgages by housing. So that was sort of a bit obvious that land was involved. In 1991 and thereabouts, and after 1989, there were other things blamed for that particular downturn. And in the 1970s, 74 afterwards, it was widely believed that it was the oil market that and significant rise in oil that brought on the trigger for the recession. But as I demonstrated in my book, you can link, and it's been very clear to see in the United States, you can link about every 18 to 20 years, and it's been as reliable as you can imagine back to 1800, which I traced in my book. You can see that after we've had about 14 years up of rising American land prices from the bottom, and the bottom of the prior recession was 2012. After you've had 14 years of rising prices, we get another crisis. And at the moment, since 2012, we've had 13 years, very good years, of rising American land prices. Well, AKA these days it's read as house prices, but it isn't. House prices don't go up. It's the land underneath that increases in value. And we are at year number 13 now. And here we are. We're starting to get a few interesting developments, which what I would consider is towards the end, that would tell us we're sort of at the end. And here we are again facing interesting problems that we've got to get over, which is, of course, the US federal government deficit and debts in general, and worries about the United States dollar and other things, which for me is quite normal as we go into the 13th year of a real estate cycle. And the thing is, because every single economist these days, if they've come out of any university, especially in America, they will not have studied the land market, so they won't know how to identify the moving parts that will tell them that we're coming into the top, and to prepare for a land price led recession, which, as you know, I've been saying would happen as we go into 2026 and after. And I've said that to you before many years ago, and I've said it. I've been saying it consistently since 2012, and here we are. Yeah. So,
so what's the story with oil? Like, what do you make of that trip to the Middle East? And why does that? Okay, so what I'm looking for is signals, and you've started talking about them, but you did mention this one. That sounds like something that is anomalous. It's usually, presidents, their first trips are usually to Europe. This time he went straight to the Middle East. So why is that a big flashing sign for you, or big neon light?
Oh, it's flashing in the sense that there's so much money coming out of there, which is significant because that's where the rent is these days, and it's been that way for several decades. So apart from anything else, I didn't find it surprising that we have a president that's involved in real estate all the time, and he'll go to other wealthy rent generators, and that's what basically Saudi Arabia is. It's that's the economy is based on economic rent which is what oil is basically. So yeah, I didn't find that surprising, like many people did. I also it's not the only. There are plenty of other things that give us the indications, and that's bank spending and the housing market and various things. So it's not.
So let's talk through some of those then. But one thing that I'd like to back up to, you already mentioned, was the dollar's reserve status. And its role as the global reserve currency, this idea of exorbitant privilege. What's going on with that, and how does that feed into the end of the cycle that we're?
Yeah, that's good questions. Before we get there, I should also point out that the last few years of every single real estate cycle have been frenetic, in the sense that speculation really does take over. And usually it's in some new thing, and I think Bitcoin would qualify for that. But also, behavior comes forth such that we all get carried away with absolutely everything we shouldn't be carried away with, and it never allows us to see the signs that the real estate cycle is topping. And so as we went into 2005, 6, and 7, I don't know if you may recall that we all became absolutely, I don't know the word, we are absolutely overwhelmed by people who were just simply becoming famous for being famous because of all the new things that were happening. We had all the new apps coming out. Then the iPhone launched in 2007. And so you could become, and it was like Paris Hilton that was just famous for being famous. And we followed absolutely all her moves. I mean, I traveled through the US I was still putting together my book, and I came over once a year, and I loved coming there all the time, and I went to a different state each time for about a decade. And I specifically remember being, because I was in St. Louis and I was researching Roy Wenslick and other things, and this was 2005, 6, and then 7. You could not travel through an airport without catching sight of Paris Hilton on the TV. Absolutely staggering, just what was going on. And then you come to today, and we have an American president that does things quite different, and it's probably good to have something refreshing in the White House from time to time. But from his worldwide wrestling federation days, where he's spent learning how to polarize society and get people rolled up and emotional. This is exactly what he's doing. And so everybody is focusing on what the president is doing, what he doesn't do, what he does do when he accepts a 200 million or 300 million aircraft. Is this unethical or is it not? And I don't have an opinion either way. What I look at is all this behaviour as a very clear signal. And as we go further into it, absolutely everybody's going to get heavily involved or polarised. You're either for Donald or you're against him, and you don't see the wood for the trees, and so you miss what all that's trying to tell you. And what it's telling you is we are coming into the final years of the real estate cycle, and it could be it's going to be an interesting time for the American citizens. And in my humble opinion, I think knowing about the real estate cycle is something that you should know, because this time in the United States, and as you may remember, I've been saying this for some time as well, this time in the United States, the American citizen might be ending up with something that they've never seen before. And most other countries around the world would be familiar with this sort of development, especially third world countries, in the sense that there's a lot of people a lot of countries that when they get into trouble, especially dictatorial places, and like, Turkey's been developing as such it is at the moment, the countries find when they enter a period of recession or a downturn, their central banks are unable to lower interest rates, because doing so it then fails to attract the capital that they need to keep the country paying off its debts. Now, we have a very interesting situation at the moment with America's, dollar privilege. Basically, the way the American dollar is used, the Fed can print dollars, to as many dollars as it wants, and you don't have the same economic rules apply to the actual country. I mean, Australia, to pay for everything it wants, Australia cannot print Australian dollars. Australians have to we have to produce stuff, put it into US dollars, and then buy the stuff that we want in US dollars and then bring it back into Australia. America doesn't have to do that. But this time, the way that the president has sort of been behaving, and this first became obvious with the tariff question, is it possible that people might lose faith in the ability of the American government to pay its debts? And the federal debts of America and the US dollar and all the problems, they're never a problem until they are. And right up until today, nobody's ever been worried. Nobody would ever question whether the US can actually pay its debts. I mean, of course it can. It's a big country, the biggest, and various things. But the current president has been misbehaving a little bit to the allies, but that's of course a perspective that may or may not be realistic. He's certainly doing things differently, and I don't want to get into a commentary about whether this is good or bad. I just try to observe the facts, and it might be creating a scenario whereby, and this is for the first time that Americans would feel this, whereby if we get some sort of recession, some sort of downturn, as some people thought might happen if the tariffs stayed as high as they have, if we got some sort of downturn, and if the creditors, the owners of the American federal debt, much of which of that debt is actually owned locally, but for those where it's owned internationally, if they decided to dump those treasuries and there was a flight from the dollar, the American government might find that it couldn't lower interest rates to fend off the recession, because they still have to offer higher interest rates for people to be interested to buy the treasuries. Now, that would be a scenario in America that's never happened before. And if it did happen, if we went into some sort of recession and the Fed couldn't lower interest rates, this would be utterly devastating for homeowners and for the average worker and employers, because they would not be able to get access to cheaper capital to carry them over in a recession. You sort of see the significance of that, right? You see,
we're already seeing it, aren't we?
yes, yes. And so
what are the signs that we're seeing? Yeah, go ahead.
Yeah, well, for the first time ever I think it was early April, this is what forced Donald Trump to think about what might be happening. We did see that the long bond went up, not down, as the stock market tanked. Now, I've had plenty of people over the years ask me back in 2016, 17, I'd explain the real estate cycle. I'd explain that by 2026, we should be expecting to see signs of a probable downturn and things. Somebody would ask me what might cause the next downturn. And I was often saying to them, well, it would probably be the size of the federal deficit, bringing problems with interest rates and the US dollar. Now, of course, you now have a Republican Party that's wanting to pass an awesome tax bill, and I'm not against lower taxes is probably a reasonable idea, but if you want to take the deductions from the poor, and so the rich can get even more wealthy, some might doubt that. It might create a bit of a complex issue, and it does bring forward then again from the bond market about whether this really can be afforded. And hence why I get back to number 47 in the White House. And again, I don't want to be perceived as criticizing things, because it's very easy to do. The current president, I think he's probably had some decent ideas. For example, let me sidetrack for a minute. Getting the federal government out of education. Well, here in Australia, I'm in Indonesia, but Australia, my home place, that's run by the states. I mean, that's fair enough. And having lower taxes on most people and not taxing tips and doing some of these things and rethinking the way wars are done, and kudos to the current president to, at least he's talking to Ukraine and Russia, and that hasn't been done before, and he's trying to bring the two together. I don't necessarily agree with how it gets done, but at least something's done towards it. But at the same time, with his signature policy, if he wants to put tariffs on lots of countries to raise revenue, to then use it to offset a tax cut, well, tariffs will slow down trade. It will cause a rise, even if modestly, in some prices. And then to use that to pay for a tax cut that will then make the deficit even more significant, you are going to get the bond market to start to question that. And we could get what was commonly referred to as a Liz Truss moment, whereby
explain what that is, will you? Because
that's when she tried to introduce. Yeah, that's when as the United Kingdom Treasurer back in 2022, she tried to introduce substantial tax cuts that the bond market in the UK deemed
unfunded,
couldn't be afforded, and so the interest rates went up. Right, catastrophic, because it meant much higher borrowing costs and indeed more expense for the UK government paying interest on that.
And the pound tanked as well, didn't it?
Yes, correct. Now, the pound isn't a reserve currency as such and things, but this could start some sort of cascade moment, right? So we do have to start watching that. Now, the significance of that for me is, yes, now, all right, we have an interesting situation, but normal economists will look at that and they'll say, yes, well, you don't want the US government, federal government having higher borrowing costs and various things. But the way I look at it is, if President Trump had tried this, and he sort of did back in his first term between 2016 and 2020, back in at that time frame, in those 4 years, according to what I do and the way I calculate from a real estate cycle perspective, that was the strongest part of the real estate cycle, where it's most productive. So nobody would have raised the same issues about where we are now, which is the end of the real estate cycle, whereby we are looking at what normally happens into the 14th year of a real estate cycle. We get a land price top, then we turn over. That's what everybody will miss. And if it does turn over whilst we get the same problems happening with tax cuts that are basically unfunded, makes the federal deficit worse, and people start moving out of the dollar and things, this is going to make this has the potential to be a very serious downturn, simply because land prices, they've already been up for 13 years in a row. History suggests, back to 1800, which I document very clearly in my book, history suggests that after the 14th year, you get a downturn. And if we get a president and a Republican Party embarking on policies that could make that downturn worse before the downturn starts, well, then we are in a significant place. Yes, and that's why I, with my work, why I encourage people to understand the real estate cycle. I don't get into anything about changing the world. I just show them how the real estate cycle works. I offer them a different scenario about being prepared for these things. And here we are. Very interesting.
Phil, just to put your mind at rest.
Yeah.
And I also think about this all the time. You know, it's very difficult to talk about, especially the current administration's policies and economic doctrines, without being political.
Yes.
But the entire point of this season of conversations that I'm having is to look at what's going on through a real estate lens. So dispense with any kind of political concept. How does this affect real estate? It's the only thing that matters. So then you can basically eliminate politicization of the conversation. How does it affect real estate? That's the only thing that matters. So with that in mind,
we're now ready. We're ready for a downturn, and anything that happens from here on that could make the downturn worse, which would be a significant increase in the federal deficit, which would be where interest rates couldn't be lowered. That would be devastating for valuations in the real estate market if that happens. And this would be a first for American investors and American real estate holders, whereby the Fed may not be able to lower interest rates like they normally would, because they need the capital to keep funding the federal government. And that's something Americans haven't seen before. Australia's familiar with it. Lots of other nations are familiar with it, because we have to deal with those normal economic policies. But it hasn't usually applied to the US in the past, because the US has a dollar privilege. I hope I'm making sense here, right?
Yeah, absolutely.
Yes, and the thing is, what nobody will get from anyone else, which is my specialty, is that real estate cycle. And it is clear that we've had 13 years up of the real estate cycle. It's completely clear since the bottom in 2012. Anybody that wants to go on Zillow, wants to get real estate market statistics, will see that the US real estate market, as an homogenous United States statistic, they bottomed in 2012. Yes, and I've been saying that for years. I know it's simplistic, but just add 14 years for the next top 2026. Yes. Now,
all right. Yeah, go ahead.
Yeah, sorry. Yes. So
let me ask you this then. So,
yes.
So you talk about so there's nothing anyone could do to stop the cycle from going through its natural course, but there is plenty that you can do to either soften it or make it worse. And the case that you're making is some of the policies, the economic doctrines coming out of 47, out of the White House, are looking like they could make it worse. And here's one. So what about the impact of the federal independence of the Federal Reserve and on stability and how deep this could go, and the pressure that Trump is placing on the Federal Reserve to lower rates at a time when it doesn't want to, and as you've said, in an environment where potentially it simply cannot.
Yes.
How do you deal with that?
We haven't hit that scenario yet. So there could be room over the coming months if things get a little bit stressed. I think there could be room for the Fed to lower rates. I personally think there probably is room, and the Fed is usually behind the curve. So it wouldn't surprise me to get into towards the end of the year, even after June, July, August, to possibly see the time come for doing something like that, which will just send investors into overdrive, because lowering of interest rates capitalizes immediately into higher land prices. A a reduction of taxes, because Adam Smith clearly showed that all taxation is at the expense of rent. So a dramatic lowering of federal taxes, that will capitalise into land price. So there's every reason why land price will keep going up at the moment. So the timing isn't quite there yet. We're having these things at the moment that we're looking at, like the doubts on the dollar and various things. But I think we'll overcome that reasonably okay, sort of. But the pressure will always be there, because this time we are at the end of the real estate cycle, and it's not only. I think what's more significant, other than just the independence of the Federal Reserve, there's plenty of people in the Republican Party, I think, that would like to see the abolition of the Federal Reserve. I don't have an opinion on that, really. Me personally, I don't think it would make a great deal of difference whether the Fed's there or not. But more significant, I think, is how the Republicans, and this is why it's been so significant to me, right back to 1868, when towards the end of every real estate cycle, a Republican comes into government, the very first thing they do is get rid of all bank regulation. It's the very first thing they do.
That's exactly right. It's exactly what's happening right now. And therefore, what does that do, Phil? Come on.
Well, it means that
secret life of real estate and banking.
Yes,
feel it.
Not only do they get rid of the regulations, I show people, it's on the front cover. I describe in about 3 sentences what the whole real estate cycle is. It's about recovery, and then the banks doing absolutely everything they can after the recovery to get rid of all the rules and regulations so that they can go back to full banking lending.
They can have another crash.
Yes, precisely. And so, here we are. So
that's funny.
Yes, and so
it's so fascinating. I'm so happy to talk to you, Phil. You're like the only person that I feel like is speaking a reflection of my own thoughts, like on every single level. Yeah.
Yes. And so not only are we rid of the regulations, but we're rid of the institutions that measure some of the statistics that an investor would need to see to help judge where we are in the real estate cycle. So no longer will banks be declaring their loans. No longer, they'll be doing absolutely everything to hide the figures. Should things get worse, they won't make this public. This is all the stuff you need to know. But if you know what the real estate cycle is and how it behaves towards the end, you can come to expect the fact that there'll be less regulations and there'll be less statistics come out, the sort of things you need to know. So hence, rely on the real estate cycle and study the land market, not banking. You study the land, not the banking, because the land is even more important than banks are. And so let me give you,
keep on going.
Let me give you an example of why you can study the land market and relate it to the real estate cycle. And this is where the great W.D. Gann comes in. Gann was a stock market trader back in the early 1910s, 20s, and 30s, back to the last century. I think he has to be possibly one of the smartest men that ever lived with the work that he was doing. In a nutshell, Gann worked out how to read a chart. He worked out that the stock chart, the prices that you see, the bar charts and the line charts and everything else, charting the stock market, US stocks and the indices. Gann worked out that there is two sides to a chart. There's both the price and, on the bottom axis, the time. And he found out that whatever you do with price, you can do with time. It's absolutely staggering and unbelievable. And that helped him determine how he could read charts to tell him where he was in certain positions. Now, to bring that back to the very basic and simple level, back in 2023, you might remember that the Silicon Valley Bank collapsed, and then generally there was big fear in markets because everybody said it would lead to another banking collapse. Everybody was thinking of what happened in 2008. But what was happening at that particular time in March and April, as the banks tanked, as the internet banks at least tanked anyway, US house builders, stocks like Lennar, Toll, DB Horton, I think, was another one. Those stocks, amongst others, but those particular three, because they're three of the biggest, they were what Gann would have suggested. The prices were accumulating at highs. And so that was telling you that that looked like the housing market was going to go very well. And in April, whilst all the people were focused on the banks, in April those stocks broke out into all-time new highs, which from a Gann perspective would tell you that in 9 months or 6 to 9 months' time, the market believed, that the people who studied the housing stocks, those people in the market believed generally that in 9 months' time, those housing stocks would release good news. And when the good news did come out 6 to 9 months later, the stocks had already priced that in. And that's one of the secrets to being able to read all about stock prices. Now, I happen to know from my studies of the real estate cycle that the index that peaks first are US housing stocks. Now, they peaked back in 2005, and they peaked first back in 1987. They generally peak about 2 years or a year and a half before the land market, which peaks a little bit before US stocks do. Now, if you think about that scientifically, which is why I got back, which gets me back to this pencil, and it drops. The law of science says that it drops downwards. The law of economic rent is all about land prices and where prices capitalize. Now, if you think about this in a just an earnings perspective, scientific if you like, but the reason why they peak first towards the end of the real estate cycle is because that's the analysts having worked out that because land price has become too expensive, the profits of house builders can no longer be sustained in an upward direction. So the market will start pricing in lower earnings because they're having to pay too much for land price. And so that's what you can do when you understand that land is a third factor of production, which never ceases to amaze me. Almost nobody in the United States does this. Now, there are plenty of very smart analysts on the stock market in the US, very smart people, and they are quite capable of suggesting that the housing market, the land is now overpriced. And if you have a look at Lennar and Toll and DB Horton, their stocks now they're not trending up. They are now trending down, and they're breaking into new lows. Now, the analysts are smart there. They're not dumb people at all. They've worked out that there'll be lower earnings on that. The brilliance of what you can do when you understand the land market, and this is all in my book, is that you can put that knowledge within the context of the real estate cycle. And if that starts happening after we've already had 13 years of rising land prices, it tells you the cycle's coming to the end. And that's the noise we got. That's what we got when we filtered out all the noise. That's what happened in 2005, because that's when the housing stocks peaked last time. And this is very clear in the chart. You can see at the highs and lows that they peaked last time in 1988, I think it was. So here we are again. Yes. And so everything around me that I see, because I'm not getting carried away with the noise of all the Republican shenanigans going on, and I try not to get angry and emotional about all that, so that I can maintain my focus.
Yeah, good for you.
We are coming into the 14th year of the real estate market, and the first indicator, housing stocks, is telling us that we might be close to the peak.
Deregulation, reduced taxes, a possible drop in rates. Is it often that at this final stage of the cycle that there is a burst of optimism and enthusiasm that it's like the last burst of fumes in the tank that just give you that push of energy? Is that something you're familiar with?
Yes. Well, imagine if Bitcoin goes to 500,000. Then maybe even a parabolic rise to even 1 million. Imagine people all the money that they're going to have, all that's going to go into real estate, because the Bitcoin with the current administration, and with the banks not any more subject to any regulation, they could easily start accepting Bitcoin for mortgages and for housing. And you have another scenario at the moment with a stock like MicroStrategy. MicroStrategy and the directors behind it, they are borrowing money to buy Bitcoin, which supports a rising price of MicroStrategy, which means they can then buy more Bitcoin, and the process just snowballs up. We have had a number of stocks, a lot, that are now via the SPAC vehicles listing on the US stock exchange, and the president's two sons and the president himself have been involved in these, where they're going to copy the MicroStrategy strategy. And so this is one reason why I think you're seeing the price of Bitcoin go up. At the end of the day, this could push prices to enormous highs. That is a pyramid scheme, pure and simple. And when that unwinds, man, oh man, when that unwinds, if it unwinds, these things normally do, and it happens when you've got a declining land market. So then the people who have come into the real estate market, suddenly, if they've come in the last 2 years, they will see suddenly that the value of their house and land is suddenly worth less than the mortgage they've taken out. Then we have a scenario like what happened in 2008 and 2009 and 2010.
Bill, so you mentioned
it's starting to come together now.
I can't be, it's like really serious, so happy that we're talking. So how do you read the impact of AI in the context? Because that's something that is very unusual, isn't it? This is an accelerated productivity tool like nothing we've seen before. How does that feed into your thesis?
Well, it is, of course, something that we've never seen before, but we've seen things like it that do similar things at the end of the real estate cycle, where we all get carried away with speculative vehicles. I mean, in the late 1960s, it was oil and Boeing 747s. In the late 80s, it was madness on real estate and land and a few other things, and then 2005 and six, we all got caught up in the mortgage market and how quickly you could make money doing that. There's always something at the end that comes along to excite people, and the market after 14 years up, the stock market in particular, it doesn't go 14 years straight up, but the land market does usually, which it has. Things have to happen, I've noticed. And when I wrote my book, it's almost as if, what I came to find was that it's almost as if the real estate cycle was a living entity in such. And the real estate market tried to do absolutely everything possible to bring absolutely everybody in right at the finish. And such that when we get to the final peak, and let's say we have one more move up in the Dow and various things, the market can't top, the stock market can't top until we're absolutely all in. We have to have ourselves no more money left, no credit left. We just have to be all in, because that does bring about the top, really, where there's just nobody underneath to just keep pushing prices up. Yes, we have to have that, and I don't think we're there yet. There has to be more development, and when you've got a Republican and the president that's just gangbusters behind pushing crypto and everything else and those things, well, then there's the scenario that could develop that way. So.
Okay, so let me ask you this then. So other than having not read your book, I'm seriously, Phil, I sit here and I think exactly the same as you. I've learned from you in the past. I've read your book. I see these things, but I also see them from my own experience, having been in this industry for actually 40 years. So I've seen several major cycles during that time. And I just see the real estate industry, the people in the real estate industry, the only signals they're reading are the old ones. What's the cap rate? Rent projections, employment growth, like the usual metrics that they're looking at. Why are they missing it? Why is it, when it's so obvious what's going on, does the industry just keep trundling along as though everything's going to keep on going up?
Yeah, it's a good question. I don't have an answer to that one. You do have to have a little bit of fresh thinking from time to time. I guess one reason is in the sense that real estate as an asset class is probably not so volatile over the years. I mean, I could probably stand corrected in some way about that this cycle, in the sense that COVID brought on some difficult times. It wasn't easy to manage real estate through that particular time. It was difficult for some commercial places, and my family, we've got commercial, so I know how that felt. And then you end up, the government does, and go back to the policy whereby you try and force, for a little while there, workers had the upper hand where they could work from home, but in the finish, I think the investors had the upper hand there, whereby I said, well, you've got to come back to work because you have to give my commercial property a reason for existence and more value by coming back to work, right? Well, they've got the upper hand there, and so that eventually was what was happening. And I know for myself, running a business, that working from home is not always the most productive environment. And I was, to be fair, I was trying to get my staff back. We agreed on a couple of days working from home, but otherwise back in the office. So you get back to the status quo, don't you, really? And you say to yourself, well, thanks, we're back to normal, and then work out how to get back into normal investing. But sometimes you've got to see things a little different sometimes. And that's, I know from my subscribers and people who've dealt with me over the years, once they get their eyes opened to land being a separate entity, you can start making different judgments about investment. You can start to see that probably it's not, over the course of 14 years, probably it's not necessarily one's investment brilliance that leads to gains all the time. And so you've got to have at least a step back and say, well,
you've got to have a little bit of humility.
Yes.
Right. During the 14 years, all you need is a heartbeat and a checkbook.
Yes.
It's at the end of the day. All right. So I'll tell you what, let me frame that slightly differently as we wrap up this fascinating conversation. So so for those who do think the way that you and I think about where we're headed, how does one, or even for those that don't, but who are willing to be persuaded otherwise, how do we prepare for that? And the way that I've been asking my guests is this: if you were to be handed $1 million today, right, in cash, what would you do with that?
Yes, now that's the quintessential question. That's the $64 million question, and it's an important one. It's a very good one. Well, of course, it's not an easy answer in the sense that being handed $1 million, sometimes, first up, I'd asked whether a person is used to handling $1 million. And so for me, that's okay. I'm used to those figures, but there's some people that aren't. And, you can see that with lottery winners who all of a sudden get a sudden influx of funds. The first thing I tell people when they get that sort of influx like that is to put it in a bank and look at not a bank book these days, but look at your online account and get used to seeing 6 and 7 figures there, so that you begin to learn to be able to handle that sort of figure. But say you've already done that and say you're doing quite well. My answer right at this current time in the cycle would pretty much still be the same. I'd have it in the bank, and I'd be very wary with it, because what I call the winner's curse of the final 2 years of a real estate cycle, the 14 years up to the last 2 years, so years 13 and 14. You have to start preparing for a probable downturn, and all the indicators I look at, some of which we've discussed, are telling you that's what you need to be looking at now. This is the worst time possible to go into even more debt. It's the worst time possible. So that's step number one. You do not take on any more debt, certainly at interest rates that might be going upwards, perhaps. So that's really the first rule. The second thing is you've got to get yourself into a perspective and into a zone whereby you can cope with property prices coming down by about 20%. They're different in different areas, and that's just a general rule. But you should be able to have a portfolio that's supportable at prices that might come back 20%. Just as a general guide. If you can do that, you're quite well placed. But of course, I also suggest, and I'm not a supporter of, once you've bought property, I'm not a supporter of selling, unless it's just a really bad investment and doesn't have the earnings, but that depends on individual investor. You've got to get to the scenario whereby I suggest to people that they have to start getting themselves in a mode of presentation that will make them look exemplary to banks, where the money is, so that in the inevitable downturn, when the downturn comes, if it comes, if it does come, we might be looking at a bottom after 2028, let's say 2031 thereabouts, because years ended in one. You go back in history in America, years ended in one have just about always been in recession. So
basically it's 4 years. So it
yeah,
started in 2008 and the bottom was 2012, wasn't it, the last one?
yeah, that's right. Yes. So I think again, we're starting in 2028 back into 2031, 32. So just assume that history's, perhaps not assume, but history looks good for a year ended in one to be a recession. So by that time, you've got to be in a situation whereby you can step into a bank and say, listen, I've got a good portfolio. It's stood up well. I've got plenty of cash. I'd like a loan. Because as we know, and I found this out last cycle as well, when you're making investments, certainly at the lows, you run out of cash pretty quickly. It's not endless. And so you do need to have access to the credit. And if you can have the ability to have good access to credit when the banks won't be looking at anybody else, that's the time when you've got to be buying. So that's the time when everybody else will be screaming and having trouble. Excuse me. So that gives you then the chance to be able to, because there'll be plenty of willing sellers. So you find the best location, the most willing seller, and it's a buyer's market. So then you might be having a good opportunity because you'll be well placed either with cash or decent credit allowance. So that's sort of what I try to show people.
Phil Anderson, Property Sharemarket Economics.
Yes.
Thank you so very much for your time today. It's such a pleasure to see you. I really appreciate you joining me.
Well, thanks, Adam. It's been great.
All right, that was Phil Anderson, Property Sharemarket Economics. Phil, super good to see you again. It always is. I do love talking to you and hearing your views, mostly because as I said during our conversation, they just mirror my own point of view. And it's just nice to find somebody who actually speaks the same language that I do. Sometimes it can be quite lonely out there with everybody else trundling along as though nothing was happening. So thanks for joining me. And thank you too, dear listeners and dear viewers, for joining us today. I'm sure you found it of interest. If you're still listening now and hearing me say this, you've made it all the way through. So you know that we're onto something here. So if you would like to stay on top of what's going on in the real estate world and you have not already subscribed to my newsletter, just go to garacrowd.com, subscribe there. It's totally free. It comes out as often as I put these podcasts out, and you can always unsubscribe, of course. But I am trying to help guide you through these uncertain times with some conversations with brilliant people like Phil Anderson. So subscribe there at garacrowd.com. Okay, that's all I've got for you this week. Until next time, this is Adam Gower signing off.